Meme stock frenzy is back.
The video game retailer has soared about 800% in the last week.
The internet's favorite stock, GameStop, is back and it's up way up.
Many people wonder how GameStop became the first meme stock. Many casual investors jumped on its hype, causing even Wall Street to pay attention to its frenzy.
Whether you are in the stock market or not, you have probably heard in the last 24 hours about GameStop.
It's the year 2021, and GameStop shares began doubling pretty fast. But there's a twist. Its rise wasn't caused by any fundamental news. So what could it be? And how is this even possible?
Roaring Kitty is back. The game got serious. He and everybody chased him, and the volume is driving the price up.
Yesterday, he posted a meme that shows a cartoon man leaning forward with what appears to be a game controller in his hands. As you can hear, I'm doing deep fundamental analysis here, but traders, they seem to be interpreting that as Roaring Kitty is back.
Despite the surge in GameStop's stock price, why did supporters lose faith in GameStop? And what happened to the video game selling giant? Buckle up as we get into the story of GameStop. For years, the American video game company GameStop has been in a steady decline, and GameStop doesn't make much money from selling new games. Questions have been raised, too, about the strength of GameStop's business, which has reported falling sales and endured a series of high-profile departures from its management team.
It's been clear that the company's having problems for a long time.
Just recently, the video game company reported $1.79 billion in fourth quarter revenue. And when you compare this to the previous year's report, which was $2.23 billion, you'll notice that this is a shocking 19% decline in sales in just a year. But that's not all. GameStop reported a 16% drop in its stock price in 2016 and an additional 8% in 2017. Some people say the company's in big trouble.
Where do you believe this company is on its reinvention process?
Digging a hole that they'll never climb out of.
But how did this happen? Well, these problems started back in 2013, when the popular console generation, which we know today as Xbox and PlayStation, launched. And you see, with these consoles, a big shift happened.
They got nothing. They got a so-called visionary CEO who won't let you know what his vision is, followed by a cult. He is the Pied Piper heading off the cliff.
It is true that my investment in that company multiplied in value many times.
Every game played during this time became available through digital storefronts, and these games were ready to be used on the PlayStation Network and Xbox Live, respectively, which were operated by Sony and Microsoft. It may not seem like such a big deal, but it was, and it became hugely impactful for the biggest game retailer. But why is that? Well, let me explain. Usually, GameStop makes a big chunk of money by selling video games on discs, accessories, and consumer electronics. But the bulk of the profit from GameStop's business model comes from selling video games.
The second-hand games business is the thing that they made all of their money from.
In 2000, GameStop launched a buy, sell, trade program, allowing customers to trade in their old games for new ones. These items could also be returned for cash or trade credits.
Every time I go into a store and see one, I buy one. So collectibles make sense to me. Now, I don't know if they're going to sell the $5,000 Millennium Falcon, ship that's like Gigantor, but they've got lots and lots and lots of cool stuff.
The company also makes money through its collectibles, hardware offerings, and software. But with the digitalization of console games, the company began facing an existential threat, and that was how the issues began. To protect the business from failing, GameStop decided to diversify its offerings and went on a new initiative, which was to acquire smartphone stores. In October 2012, GameStop acquired Simply Mac, the largest certified reseller of Apple products, and Spring Mobile, the fastest AT&T authorized retailer of wireless services. By 2018, GameStop owned more than 1,200 AT&T wireless stores. Do you know what's more interesting? GameStop kept on buying and buying, and they were paying top dollar for these acquisitions. But their earnings soon went down as fast as they were acquiring these companies. Now, the Spring Mobile stores GameStop acquired were supposed to generate about $1 million apiece. And when these stores couldn't generate that kind of money, they became a very expensive liability for GameStop. But wait, there's more. These stores were supposed to do $1 million apiece. So with 1,500 stores, you're looking at $1.5 billion in revenue and double-digit margins. So with the investment GameStop made in these acquisitions, it was supposed to generate $150 to $200 million profit. But guess what? They could only get to $80 million, and they were just never close.
The bigger issue here is that they missed consensus in terms of earnings by a country mile. They lost a lot more money than investors were expecting.
Let me tell you the craziest part. Before these acquisitions were made, GameStop had more than enough cash in the bank and had zero debt. But by 2018, when Spring Mobile was sold for $700 million, the company was already swimming in debt. Now let's do the math. GameStop spent about $1.5 billion buying all these stores, of which these acquisitions were done with $700 million in cash and $800 million in debt, and they ended up selling for $700 million. Isn't that insane? That's over $500 million lost.
The company just screwed up royally by diversifying into stuff that made no sense at all.
In the process of all these, GameStop not only lost the money it had initially spent, but it also incurred hundreds of millions in debt. GameStop, which was doing fine, went from having no debt and generating about $400 million in cash to having $800 million in debt and generating $300 million in cash. And by 2018, GameStop was looking for buyers from private equity, but potential buyers couldn't convince financiers that GameStop was a smart buy. But why was GameStop looking for buyers? Well, let me explain. Even if the business was declining, GameStop had a stock price of $16 per share in 2018. And this was enough to interest private equity groups looking to purchase the ailing retailer. But despite the efforts the buyers made, they still couldn't convince banks to finance the purchase. Now listen, in the wake of GameStop's inability to sell in late 2018, the company's stock went on a free fall. Between January 28th and January 29th, 2018, the stock dropped from around $16 per share to around $10 per share. Interestingly, another similar drop happened on the 5th of June that same year, which dropped the company's stock price to just over $5 per share. At the time, GameStop was already struggling to maintain customer loyalty. Now look at this. When GameStop was up for sale in late 2018, the company requested $16 per share, which means that in the last 6 months, GameStop had lost around $1 billion in shareholder value. And about its inability to get sold, there are several reasons for this. First, at the time, there was largely a measure of uncertainty about the future of game consoles. And in late 2018, it wasn't clear if the next PlayStation and Xbox consoles would even have disk drives. If they didn't have disk drives, then there would be no discs to sell, thus cutting out the core of GameStop's business. Fortunately for GameStop, in 2019, it became certain that the PlayStation 5 and Xbox One Project Scarlet would come with disk drives, which Sony and Microsoft confirmed. Despite these releases, it wasn't enough to bail out the already struggling business. If we go back to when consoles were released, this time was a pivotal period for GameStop because of the advent of online services from Xbox, PlayStation, and Nintendo, which were offering downloadable digital versions of their games. Not only that, Apple's gaming subscription service called Apple Arcade and Amazon's Crucible for PCs also had an impact on GameStop. Popular games like Minecraft and Fortnite started becoming available on mobile, and these games began attracting a huge community of gamers, which would in turn eat GameStop's profit margins. As of October 2, 2020, the company's stock price closed at $9.39, and even before then, in 2010, people began to report that stores were already looking worn and exhausted.
And anybody who goes into a GameStop kind of knows that the shops seem a little bit shabbier these days. I hear that a lot. They look as if they're going down market all the time.
Since PlayStation had a heavy focus on digital downloads and offered cloud storage, it completely eliminated the need for retailers like GameStop, which would further hurt the business. Some publishers report that digital game sales outweigh physical game sales in the gaming industry, which is also eating further into GameStop's profit. In 2019, GameStop's net sales for new and used games were $3 billion, which was 16.6% less than the sales it made in 2018. It was clear that digital downloads became a thing, and GameStop's business declined. The rise of downloadable video games isn't the only thing that has allowed GameStop to decline in business. The 2020 pandemic has also added to the company's woes, because when stores shut down, store sales fell by more than 12% from 2019, with the majority of the stores open for only limited customer access. GameStop has been feeling the pressure, but it hasn't always been like this. Back in the glory days of GameStop early in its career, when all was well with the company, it made quite a lot of money to expand. From the early 90s to 2005, GameStop dominated. It acquired rival EB Games, formerly known as Electronic Boutique, for $1.44 billion, and this expanded its international presence into Australia, Canada, Europe, and New Zealand, making GameStop the world's largest video game retailer with over 4,250 stores worldwide. On December 4th, 2007, GameStop stock reached an all-time high of $63.30 per share, and the company had a market cap of over $10 billion. Its physical operations kept on growing. It had over 6,000 locations in 15 countries. And even up to 2016, the company had acquired over 10 different companies to expand and diversify even more. But its biggest mistake was in 2018, which was to acquire Spring Mobile. And the financial results for 2018 showed the biggest loss in GameStop company history, losing over $673 million. Although it wasn't all bad news for GameStop, when its stores shut down during the pandemic, its e-commerce online sales rose by over 800% from the year prior. However, all the ups and downs in the past for GameStop are nothing compared to stock incidents that caused many people to gain a lot of money and some people to lose a lot of money as well. In 2020, when the pandemic hit, many investors were suddenly looking for ways to make money from the stock market. These investors stumbled on something called Wall Street bets, and they kept seeing posts on GameStop, particularly Roaring Kitty, which was also a huge sensation in the meme coin frenzy thing. Whenever a post came from the account, people got excited and said the meme stocks were back. Interestingly, Roaring Kitty went dormant in 2021 until the 12th of May 2024, when a meme tweet of a person playing video games leaning forward in his chair surfaced. And this sparked reactions like,
short interest in GameStop.
This GameStop situation is the craziest I think I've ever seen.
But let's just say that you have a stock right now. What's to stop a company from going up to this Roaring Kitty guy and go, hey, in a couple months, do us a favor. Here's $10 million. Go put a meme of a guy leaning forward in something, whatever, to make our stock go up.
What everyone is excited about is that yesterday he posted a meme that shows a cartoon man leaning forward with what appears to be a game controller in his hands. As you can hear, I'm doing deep fundamental analysis here, but traders, they seem to be interpreting that as Roaring Kitty is back, whatever that may mean.
In 2021 alone, previous posts from Roaring Kitty have soared GameStop's stock price by over 50%, which helped save the struggling company at the time. Now, Roaring Kitty is back, and the recent post from the account has sent GameStop shares soaring by over 74% in 2 days. The Roaring Kitty account was later discovered to be operated by a man named Keith Gill, who was also active on Reddit and YouTube.
As for me, I like the stock.
He is the most popular Roaring Kitty on Twitter X, and many may call him
the Basement Bandana Man,
who's responsible for spiking the skyrocketing GameStop's share price in 2021 and now again in 2024. He thought GameStop's stock price was dramatically undervalued, and he used his influence to gain more followers and retail traders that would end up buying more of GameStop stock. And the biggest of them all, Roaring Kitty was one of the central figures in a short squeeze in GameStop stock in 2021. And this happened because a group of the meme frenzy fans, which a lot of people may find funny, figured out that if they collectively bought into GameStop stock, they could bet against hedge funds who could have predicted that the company's stock would plummet due to GameStop's decline in sales.
Roaring Kitty, his real name is Keith Gill. He played a starring role in the 2021 meme stock mania. He really helped to rally day traders behind the cause of squeezing GameStop short sellers.
And the plan worked because after these groups collectively bought, the stock price went skyrocketing, forcing these hedge funds, who were short sellers that intended to make money as long as the stock kept on falling, bought back higher, causing what's known as squeeze. And yes, GameStop stock went from $3 per share to $347 per share in 2021, and several large hedge funds were severely wounded. Many may call this the Eat the Rich saga, which was also the title of a Netflix docu-series on the GameStop saga. But what do you think? GameStop isn't out the door yet, and what might benefit the struggling company is its great number of fans who prefer buying the physical copy of the video game to the digital version, which also allows them to trade in their old copy.
So I think that they're here to stay. I think people who value trade-ins are going to keep buying physical media.
Well, many may say the business is a melting ice cube, and eventually GameStop will go away. Not only that, Webush's Michael Pachter estimates GameStop's got about 10 years before that ice cube is fully melted. What are your thoughts? Could the striving business benefit once again from the meme frenzy trend? And can GameStop regain the faith of its supporters by becoming the giant video game company everyone once knew? Share your thoughts in the comments below. And as always, don't forget to like if you enjoyed this video, and smash that subscribe button so you don't miss out on new videos. Until then, see you next time.